So you're looking to invest that extra $500 that you have left over at the end of the month. Congratulations, that's the first step. Now, I want to talk to you about a very important concept that a lot of beginner investors have a hard time grasping, which could cause you to lose a lot of money, and that is short-term versus long-term investing. Specifically, what are the differences between the two forms of investing? What should you expect? And most importantly, which is best for you? Hey, my name is Isaac, and I'm a registered nurse and personal finance YouTuber with over 7 years of investing in the stock market. I've created a steady source of income through the stock market, and now I want to share what I have learned with you. My goal is to help each of you achieve your financial goals, so today's video is going to be focused on those of you who want to invest your money in the stock market. Make sure to stick around until the end, as I'll be letting you in on the secret to making the most possible money from the stock market. Hey, if this sounds like something you're interested in, please leave a like and subscribe to the channel. It really helps to get this content out there to more people just like you. So without further ado, let's get into it. Gone are the days when people relied only on their savings to ensure their financial stability in the future. With rising interest rates and APYs less than 1%, the money that you have in your savings account is losing value. Money in your savings account or locker that isn't being used may also be ineffective. That's for two reasons. First, having idle cash in your bank account is a waste of money since it can't be used to produce more money. And second, it can't be used to beat inflation. So what is the solution then? Well, the answer is investing, and my favorite form of investing is buying stocks. Investing gives financial stability both now and in the future. It enables you to increase your wealth while also generating inflation-beating returns. Compounding is also advantageous to you. Furthermore, investments have the ability to help you achieve your financial objectives, such as acquiring a home, developing a retirement fund, and establishing an emergency fund, just to name a few. Now, there are two types of investments. One is short-term and the other is long-term. Let us start with the short-term investment. A short-term investment is one in which you expect to get your money back in 3 years or less. Your investing approach should ideally protect your money from losing value in such a short period of time, and that usually entails a trade-off. Your money will be safer, but you won't experience as much gain as if you invested in a riskier investment vehicle. A short-term investment will require a lot of time and research because you'll want to know the ins and outs of a company to determine if it will be profitable in the near term. Oftentimes, this entails looking at quarterly income statements and balance sheets. You may also stay up to date on news surrounding a company to determine if this is the right investment for you. Now, let's give you a couple of examples that can help you invest in the short term. The first is a high-yield savings account. Now, I personally do not have one of these accounts because rates are so low that it isn't enough to keep up with inflation. However, with 4 interest rate hikes expected this year, I am keeping an eye out on high-yield savings accounts that have a good rate of return, preferably above 3%. And if savings account, the bank will pay interest on a regular basis. It's a good idea for savers to compare high-yield savings accounts since it's easy to figure out which banks give the best rates and they're simple to open. You won't lose money since savings accounts are covered by the Federal Deposit Insurance Corporation, or FDIC, at banks and the National Credit Union Administration at credit unions. In the short term, these accounts pose little danger, but investors who store their money for longer periods of time may struggle to keep up with inflation. Savings accounts are quite liquid and you may add to them at any time. However, savings accounts limit your amount of withdrawals every statement cycle. Of course, you'll want to keep an eye out for banks that impose fees for things like keeping accounts or using ATMs so that you can avoid them. Another example is a short-term US government bond fund. Government bonds are similar to corporate bonds, except they are issued by the federal government of the United States and its agencies. T-bills, T-bonds, T-notes, and mortgage-backed securities are among the investments purchased by government bond funds from federal entities such as the Government National Mortgage Association. These bonds are thought to be low risk. While the FDIC does not back bonds issued by the federal government or its agencies, the bonds are the government's guarantee to return the money. These bonds are regarded as highly safe since they are guaranteed by the United States' full faith and credit. Furthermore, an investor who invests in a short-term bond fund assumes a modest level of interest rate risk. As a result, increasing or decreasing interest rates will have little impact on the bond prices of the fund. So what makes a good short-term investment? Well, short-term investment is usually characterized by 3 traits. The first is stability. The value of suitable short-term investments does not vary as much as that of many equities and bonds. The money will be there when you need it, and it is generally insured by the Federal Deposit Insurance Corporation or backed by a government guarantee. The second is liquidity. A solid short-term investment generally has high liquidity, which means you can get back your money quite quickly. Finally, the last feature is a low transaction cost. These investments typically don't cost a lot of money to get in. This is important since yields on short-term investments are usually low. These characteristics characteristics suggest that your money will not be in danger and will be available when you need it, which is one of the main reasons to invest for a short period of time. Long-term investments, on the other hand, might yield a bigger return but come with more short-term volatility. If you really need that money, you might have to sell it at a loss to get it. Long-term investments are assets that a person or business wants to keep for longer than 3 years. Stocks, real estate, cash, and other instruments that facilitate long-term investments are examples. Long-term investors take on a significant amount of risk in order to get bigger profits. Long-term investments are not affected by market movements in the short term. Such investments, on the other hand, may be rich enough to reflect a decrease in market value. Long-term investing is expected to result in significant wealth accumulation over time. Many people who lack the skills necessary to trade rely on long-term investment returns to plan their financial future. Now, I make a monthly income from trading the stock market, but over 70% of my money that I have invested is in long-term investments. I have a 5 to 10 year trajectory on some of those. For those of you who have been following my Instagram for a while, you know how much I love a company called Beyond Meat. I think that plant-based meat sources are the future and that its prevalence will grow, especially in the United States. Now, because I have such a long-term trajectory on this company, I don't mind losing money in the near term. In fact, the current price of the stock is around $40, but I started to buy when it was $90. Because I believe that the stock could reach $300 plus within the next 5 years, I don't mind the short-term loss. In fact, I keep money on the side to average down my position. Now, some long-term stocks you can hold include dividend stocks. This method of investing takes less time since investors do not have to monitor markets on a regular basis for modest swings, and dividend stocks usually pay you a set amount each quarter. This can be a great strategy for you if you have money lying around and you want to make some money off of it passively. Aside from the risk aspect, brokerage fees and capital gains taxes make up the majority of the costs of investing. Transaction fees are paid less frequently, if at all, by long-term investors than by short-term investors. Many investors can avoid hefty capital gains taxes by allowing their stocks to sit for 365 days or longer. Short-term earnings are also taxed at a higher rate than long-term capital gains. Some disadvantages of short-term investing is that it comes with high costs due to high transaction volume and the corresponding brokerage commission fee. Taxes and inflation are also bound to put a dent in the returns earned via short-term investing. Another con is that short-term investing usually involves a certain level of expertise, as investors will have to monitor the price movements and identify purchase or sale spots more rapidly. So you might think that long-term investing is the obvious way forward, but think again. Investing for the long term implies that you have no immediate plans to use or remove the assets. You've got money lying around and you don't mind taking the short-term loss for the possibility of a long-term gain. Another con is that you usually don't pay a lot of attention to your investments and you might miss out on some opportunities to make a lot of money. But the argument against this is that you didn't invest in the long run to beat out small price swings in the near term. Oh, and long-term investing is not for the emotionally vulnerable. When it comes to investing long-term and not tinkering with your stocks, it may be pretty tempting for people to sell, purchase, or shift any holdings anytime there's a drop. Well, this isn't good for any investor looking to make some sizable gains. So you need to be a little more patient and survive the dips. So this might have made it clear that both investment plans carry their risk and issues. The most profitable approach to investing is to base it according to your needs and goals. When it comes to investing goals, if one has a long-term goal such as acquiring $1 million big house, he or she should consider purchasing a long-term investment to help fund the house project. When a specific quantity of money is required at a specific moment, short-term investment is preferable. It might be anything from buying a car to taking a trip. Take me, for example. I started trading when I got my Ford Mustang GT so that my trading income could pay for my monthly car expenses such as maintenance, the loan, gas, and insurance. Now, the amount of risk associated with each investment is different. There are risk-free investments such as government bonds and risky investments such as unsecured loans to firms in financial difficulties or new enterprises or startups with no track record. The larger the risk, however, the higher the possible reward an investor could claim for accepting that risk. Volatility or changes in the financial markets, which may cause assets to lose value, are one of the biggest hazards that long-term investors face. In this instance, the key risk exposure for short-term investors is the purchasing power risk or the risk associated with inflation. Investment earnings may not be worth so much as long as inflation rises, causing the currency to depreciate. So smart investors typically diversify their portfolios by investing in both short-term and long-term assets. Diversification is the process of dispersing risk across a variety of investment vehicles. It is one of the best ways to secure your investments, so even if you sustain a loss from one side, the profits from the other will be able to offset that loss. In the end, all investments depend on the situation of the investor, and it is paramount for them to know what they want before you start putting your money into any investment plan. So we recommend that you first make a plan of what you want from your life, and only after careful consideration should you delve into the world of investing. So I hope that helped you guys out. Which method of investing suits your style best? Personally, I keep a mixture of short-term investments and long-term investments. I love buying long-term investments in my retirement account because I hardly look at it and it helps me to avoid selling if the price drops. Also, I can't withdraw it until I'm like 60 years old. Anyways, if you found this video helpful at all, please consider leaving a like and subscribing to the channel. That's all we got for today, and I look forward to seeing you all next week. Peace.